Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Disney stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 164 billion market cap. They're trading at $90 a share and they have 1.8 billion shares outstanding. Disney operates theme parks all over the world. It also offers streaming content. It owns FX Productions, Lucasfilm, Marvel, National Geographic, Pixar, Searchlight Pictures, and 20th Century Studios. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have $2 billion free cash flow in 2022, then cut in half to $1 billion in 23. Then it blew up to $5 billion in 24, nearly $8 billion in the trailing 12 months. That's a trend you want to see. Free cash flow margin is getting stronger, 9% in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's grown a lot from $2 billion to nearly $5 billion, and it doubled from 2024 to the trailing 12 months. Revenue is a sales for the company, and that looks amazing, from $67 billion to over $90 billion. The first time they ever hit over $90 billion in a 12-month period. They do pay a dividend of 1%, which cost them $1.6 billion, but they can easily cover that dividend because they generate $8 billion of free cash flow, which is almost 5x their dividend payment. We estimated 4 years of future free cash flows. We also estimated a terminal value of all cash flows past year 4, that's $178 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $159 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of $87. They're trading at $90, so they're trading at a 3% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. Simply Wall Street is in the other direction as me. They're at $127 a share. They say they're 29% undervalued. 28 analysts price this stock at $112. They also say it's undervalued. There are 42 companies in the same industry as Disney, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx by far. This is the purchase of property, plant, and equipment. They buy a lot of PP&E for their theme parks. They have a really good debt to equity ratio. For every dollar of equity, 50 cents of debt. They pay a 1% dividend, which is about the average. The median and average is of the companies that pay a dividend. If a company does not pay a dividend, they're excluded from the calculation. Because if I put a 0 for every company that offered no dividend, most industries would have a really low average. Disney generates the most free cash flow, $8 billion, higher than Netflix. They rank second in market cap, a little more than half of Netflix. Really good price to book. Price to book is stock price over book value per share. Book value is assets minus liabilities in a balance sheet. The higher the assets, the higher the book value. The lower the liabilities, the higher the book value. They're trading at 34 times earnings, which is a little worse than the median. 21 times free cash flow, pretty close to the median. And they're trading at 1.8 times revenue, which is a little better than the average. They generate the most revenue by far of any company. You could take Netflix's revenue, Live Nation's revenue, and Fox's revenue, and sum them all up, still lower than Disney. Disney's 5-year annual revenue growth rate is 7%, which is a little better than the average. Roku is number 1 at 33%. Here's their latest income statement, the second quarter of 23, second quarter of 24. Revenue is up slightly. Service revenue went from $20 billion to $20.8 billion. Product revenue is almost identical at $2.3 billion. So total revenue, $23.2 billion, up from $22.3 billion. All the expenses directly tied to generating the $21 billion of revenue is $13 billion. All the expenses directly tied to generating $2.3 billion of revenue is $1.5 billion. So their service revenue has better margin. Then you have SG&A. This includes marketing, $3.9 billion, depreciation, amortization, $1.2 billion. So total expenses are up a little bit. Last year, they took a big impairment of $2.7 billion. An impairment is when you write down the value of an asset on your balance sheet and pass through the loss onto your income statement. Goodwill is a common type of impairment. Last year, they had an operating loss because of that impairment. This year, they have a gain of $3.1 billion. They paid $250 million of taxes, net income $2.8 billion. Last year, they had a net loss EPS of $1.43. Shares outstanding are identical, 1.829 billion in both time periods. That's diluted shares. Regular shares is lower. It's 1.821 billion. So to summarize, I have them trading at a 3% premium. I give them a ranking of 8 out of 10. The stock has come down a lot, and I still think it's a really good value. I picked it up a year ago at 85, and I was up 50% at one point, but now I'm up maybe 5 or 10%. Would I buy it? 9 out of 10. I think it's a great value. It should be a $200 stock. It will hit 200 within 5 years. I'm pretty confident about that. Ratio 6 out of 10. Price to book is better than the median. The others are worse than the median, but not much worse. Financials 8 out of 10. They're growing their free cash flow amazingly. 300% since 2022. 2 billion to 8 billion. Revenue is also up nicely, 34% since 2022. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.